only thing I'd remind you is sell on the merger or lose your money.
Welcome to this Breakout with Breaking Views, sponsored by PGIM. I'm here with Edward Chancellor, who wrote a fascinating column that looks at the SPAC boom, that's special purpose acquisition companies, of which there have been 300 or so, raising $100 billion just so far this year. Eddie, your point is to look at the historical antecedent to this, which is 1720.
Yes, Rob. We've been here before, although we might say what's going on now is crazier than anything's ever been seen. But in 1720, in London, in early that year, a couple of hundred so-called bubble companies appeared. One of which is famously cited as a company for carrying on an undertaking of great advantage, but nobody to know what it is.
That's a SPAC, isn't it?
It is a SPAC. And there are a number of other exciting businesses that the 18th century SPAC investor could invest in. A company for setting up Terra Australis 50 years before Captain Cook discovered it. Another for making starch out of potatoes. A co-partnership for trading hair. I can see Bill Ackman taking a slice of that action.
So in all these companies, they came out. What happened to them? Did investors make money? Who made money off of this?
We can't really call them investors, the people who took shares in the bubble companies. So the people who bought bubble company shares, they were issued on a partly paid basis, a sort of shilling in the pound, if you will. So any movement in price is highly leveraged. And according to the reports, some investors made 30 times their money before the bubble companies burst. And my point is that if you look at the SPACs today, everyone says, oh, the SPACs are blank check vehicles, they're shell companies in a shell game, you're only going to lose money. But if you actually look at the individual actors, the sponsors of the SPACs who get 20% of the equity, the early investors in the SPAC IPO who are hedge funds who lever their investment and get their cash back at the time of the merger, plus some warrants in the merged entities. If you look at the PIPE investors, the private equity in public investment, those guys get special under the table deals, as you know, with shares sold below market prices and other incentives. Most of the sort of professionals, I'd say all of the professionals involved in the SPAC business are doing very well out of it.
So Wall Street does well, but in the end, the public investors who are left holding the equity in these companies that are, they're blank until they merge with something, where do they stand?
Well, they stand to lose money, and quite a lot of money. And they've been losing money so far this year, and they will continue to lose money.
After 1720, of course, regulators got involved and put an end to the bubble.
But I think this is the most important thing, is that the SEC under Donald Trump just turned a blind eye to what was going on. And now clearly there's a new sheriff in town, and the new sheriff doesn't like what he sees. And then the SEC are making several comments. They're first of all saying that the warrants issued by the SPACs have probably not been properly accounted for, and it is perhaps no coincidence that you and I have never heard of the accounting firms that actually do all the SPAC accounting. Well, that's a red flag if you ever saw one. Secondly, they're saying that the SPAC companies should no longer be able to use this safe harbor provision on mergers to make the most extravagant forecasts you can see. I was looking at an EV battery producer, Romeo Power, based in California. It came out with 59% compound annual growth forecasts for 5 years when it merged with a SPAC last year. Now, in the first quarter after coming to market, it has slashed its expected earnings for this year by around 90%. So the SEC doesn't like that. And there are other things perhaps in the background that the SEC is also concerned with, which namely, the word on the street is that how can these SPAC deals really be done so quickly after the IPO? And had they really not spoken to their target companies beforehand? Because if they have spoken to the target companies beforehand, they are breaking the listing rules. And so I think the SEC is going to have an absolute field day with these SPACs going forward.
Okay, given all that, Eddie, are SPACs a complete sell? Is this the place where to seek underperformance or what? What do you think?
I think a lot of the SPACs, the listed shares, are so to speak, the ongoing big short. But what's interesting is the SPAC IPOs, which are around 300 this year, a lot of them are trading below their trust price, $10. Now, those, but bear in mind, those have to redeem at $10, and you'll get a warrant, possibly worth this, but you'll get a warrant nevertheless. So, in fact, an investment in these new SPAC, in the new recent SPACs pre-merger is not necessarily a bad deal. The only thing I'd remind you is sell on the merger or lose your money.
Sell on the merger, lose your money. Okay, on that note, thank you, Eddie Chancellor, and we'll be back with more breakouts with Breaking Views.